Welcome to Subramani. One question which I got asked last week by in a crowd is what happens to the markets when interest rates go up? I have covered this in various videos, but specifically about equity markets accept that interest rates will go up. It's not that equity market people think that interest rates will remain here for the rest of their lives. Equity markets understand that interest rates will fluctuate. So when interest rates go up, let's say in the US the interest rates go up from 0.75 for 8%, 0.80 to say 1.78. That's a huge jump, right? Or doubling of interest rates if you look at it this way, and trillions of dollars, if not billions, if not trillions, at least billions of dollars move for such a huge change, right? So yes, the markets will react, but the question is the equity markets anticipates this already. So equity markets, if the rate of increase, if the increase next by Fed, first of all, whether the increase happens. If the increase happens and it is 0.25, I don't think the market is going to react too violently, because that would be priced in. Also remember that equity markets are also themselves very high. It is not as though equity markets are low and interest rates are fluctuating. Then the equity market may fluctuate like this. But here, if the equity market is high, if you have every stock available at a P of 40 or 45, chances are the market will say, why take a chance? So a lot of people would be booking profits and coming at least, or shifting from a growth stock to a value stock. Some of those things can happen, and that may have nothing to do with interest rate. It is just anticipating that if interest rates are going to go up from say 2% in treasury to 4% in treasury over a 2-year period or a 1-year period, or the government is stopped going to buy bonds, which means there is QE easing which is happening. So our quantitative easing is reduced, or the amount of money that the Fed pumps in is reduced, or the $600 checks are gone, and the variant goes away. There's no great COVID threat, or COVID is better managed, then things could change, and things could change quite a bit. So when interest rates go down, you expect equity markets to go up. So the reverse should also happen, right? When equity markets, when interest rates go up, equity market should go down. May or may not happen, because let us talk of conventional wisdom. It says there is an inverse relationship between interest rates and bond market valuations. That is easy to understand, that when you are going to get lesser returns, their bond value will go down. When interest rates go down, bond markets will go up, because people are getting better prices in the old bonds. So people will pay a higher price. So similarly, the reverse will happen. But please understand, it is not to say that when the interest rates go down, bond prices go up. What it means is, when interest rates go down, asset prices go up. Right? It is asset prices, everything else. So let me just explain the wisdom. The wisdom is, suppose interest rates were 10% and you were getting 10% on your bond. So you had a 100 rupee bond on which you were getting 10 rupees. Now suddenly somebody tells you that you are going to get 11 rupees, then you need lesser bonds. So you are willing to say, I'll get rid of the bonds and I'll go into equity because interest rates. But the reverse is also possible, that people will say, oh, I'm getting 11%, so more, let me buy more bonds. So what happens in practical life is, when interest rate changes, theory is, especially in the short run, bond prices should, when interest rates go up, bond prices should fall. But what happens is, when interest rates go up, bond prices fall, but along with that, equity prices will also fall, because people will say, why should I take so much risk in equity? So that is the conventional wisdom, but it does not always happen that way, because internationally there are 3-4 factors. One is, how much is the inflation? Second, what is happening in gold? And third, what is happening in other commodities like oil? And today, a joker in the pack, what is happening in crypto? People think that money can move very fungibly from dollar to crypto or rupee to crypto and come back. So one more joker in the pack is that. So impact of interest rates on equity markets now going forward will be more difficult to gauge, because that could be a different market and this could be a different market. So don't get carried away by theory saying, oh, this is what will happen. Also, The theory is when interest rates go down, the people will get rid of bonds and want to put more money in equity. I have seen also people, when interest rates go down, people say, should I keep more fixed deposit, because they want to protect their cash flow. This is true for retired employees especially. So retired employees might actually shift money from equity to debt, saying, oh, if interest rates are going, if, or even the reverse, saying, oh, interest rates are going up, I don't need so much money in debt, can I put more money in equity? So all these things will happen, and everything is having an impact on bond prices and on equity prices. So be very careful, because don't compromise on quality. And I've said this again and again, and I'm saying it in every video, because in a high market, when equity markets are high, and they are high, immaterial of whoever tells you whatever, don't compromise on quality of shares, because the markets are bound to come down. Every bull market is followed by a bear market, right? There will be a party, there will be drinks, you will drink, and tomorrow there will be a hangover. To say no, now the quality of drink that I have is so high that there will be no hangover, you're fooling yourself. So there will be a hangover, markets will come down, we do not know when and by how much, and how long it will remain there. So don't fall too much for the conventional wisdom. Things are changing. There could be a 2% of Indian population investing. If it becomes 4%, equity market is bound to go up, right? So many of these things are at play. Don't just look at the 10-year treasury bill rate and say, oh, this is what is going to happen, because interest rates are going to go up. Equity markets will come down. Yes, equity markets will come down, but if the growth rate is slow, then the equity markets may not come down too fast. So don't compromise on the quality of debt, don't compromise on the quality of equity that you have.